how will this affect people's money in terms of the markets? I think there was a good reaction yesterday. In some ways.
I think the way to
the two potential portfolios have had a positive week.
Yeah.
You know, we've made money this week through the events of market-driven events. And remember, the portfolios are all multi-asset. They're not just looking at the UK.
Yeah, I think that's really of investing. I think it's when you're looking at your valuations over the last 6 to 9 months, you could feel a bit uncomfortable. I think it's worth if we could put it on the screen, it's worth just looking at the performance of the portfolios over the last 5 to 6 years on the long-term basis. Yeah, Mark, let's bring that on the screen, and Jeff, can you just talk us through that, because I think that's important.
What we can see just on the screen at the moment is a chart that
Portfolios, get money into your pension, get your tax, relief that's coming into the pension as well, and maximise those allowances.
That's a cracking part of it.
Hello everyone, welcome to the Do More of Your Money podcast. And what a week, or what a day actually yesterday, gentlemen. I'm joined by Mark, Jeff and Steve today to talk about why long-term investing is important, but also a little bit on what happened yesterday with, we're recording this on Friday, so what happened yesterday with Liz Truss. Who wants to start?
Liz, where do you want us to start?
Yeah. Well, I think let's just talk about how will this affect people's money in terms of the markets. I think there was a good reaction yesterday. In some ways.
I think the way to think about it is that the market's forward-looking. It's been quite evident, I suppose, for the past week that there's a lot of challenges. We only have to go back to last Friday. It was the Chancellor resigning. Go to yesterday, it was the Prime Minister changing. But I think what the market really has focused on was really what has come out over the beginning of the week in terms of the moves that Jeremy Hunt has made to improve the fiscal position. So rolling back on a lot of the tax cuts, the unfunded tax cuts that were originally set out, and that has brought a degree of stability back to the gilt market, where we have been seeing the volatility over recent weeks. So yesterday, actually, when we look at the currency, we look at gilts, we look at equities, really the market took it in its stride. The market's forward-looking. It was anticipating that there was going to be further change, and clearly we got that at 1:30 yesterday.
Yes, I think we did see some stability at the start of the week, didn't we, Jeff? I think. What do we think moving forward over the next week? We believe there's probably going to be a pretty quick
we'll have
election.
a new Prime Minister by this time next week, hopefully, in place. We'll know probably come Monday morning who the two, if there are two, individuals that step forward. And for me, the more important aspect of all of this is that the market has effectively set in train a set of events that say really whoever it is doesn't have a lot of scope to deviate very much from the policies that have just been announced at the beginning of the week. So continue to deliver on that, the stability that's required, the visibility that's required in terms of the action is what whoever comes into place is going to have to deal with.
Do you think, I'd probably go over to you, Mark, do you think there's a favourite that would help the markets
I think
does it matter?
No, I think the markets will react to whatever comes along. That's always been the case. We go back many years, and you can see the market does drive things. And in this one, the market might have actually driven the change because of the unfunded side of the tax cuts, etc., and the expenditure that was being made. So the market's seen off a Prime Minister and seen off a Chancellor. Whether it was their own fault, everybody has their own opinion on it.
I think that to build on that a little bit, probably the market's more concerned about who's in number 11 and not in number 10 at the moment, because actually they are going to set the agenda in terms of the fiscal direction, the potential tax increases that are needed, and the stability from a fiscal side that's required.
And do you think whoever does win may have, based on that comment, Jeff, they may not have a choice in Jeremy Hunt remaining as Chancellor?
I think the individual may or may not change, but the policies that individual will have are unable to change because we've seen how the market reacted, and we know today that prior to the mini budget in inverted commas on the 23rd, 10-year UK gilt was yielding 3.3%. We got up to 4.4. We're now at 4. So there's still a significant risk premium, if you will, that's been built into that. And that is because of that instability that's been generated. And the announcements that were made on Monday have gone a long way to helping taking some of that off the table. And that is certainly going to have to be the focus of whoever is in number 11. They can't change where we've got ourselves to at this point.
What's worth saying, Jamie, at this stage is that as of last night, as of Thursday night's prices, all 10 of the true potential portfolios have had a positive week.
Yeah.
You know, we've made money this week through the events of market-driven events. And remember, the portfolios are all multi-asset. They're not just looking at the UK.
Yeah, I think that's really important, Mark, because you can get clouded by. I was conscious when we were thinking about talking on the podcast today. On the way into work, I think I listened to 3 different radio stations, including a sport radio station, and it was all driven by what's going on in number 10. You watched the news last night. The first part of the news, it was all related to this, as you'd expect. But as we know, with the money that's invested, as you say, it's not all invested in the UK. It's
also thinking about how we invest. It's about looking to the longer term.
Yeah.
Meeting the goals that our clients have, and that's, I suppose, if you will, that's the real contrast with what we've just been talking about. A very short-term focus, short-termism that's there from a political perspective and what was envisaged. I've said something, so I'm going to do it. Doesn't matter what the market thinks about it, versus setting and training a chain of events that speak to longer-term investing, longer-term planning.
Well,
and that's not what's there, but certainly what we think about when we're investing clients' asset is how do we deliver returns over the long term for our clients.
Well, let's jump into the title straight away and we'll move on from that. Why does long-term investing matter, Steve?
Well, let's just think about it. We've got to park what's gone on now. The one thing the markets don't like is confusion, is uncertainty. You both talked about stability, big word, we need to talk about it. We need to park what's gone on and hope we've moved on. Hopefully the mistress of the U-turn won't do one and try and come back. But you never know, she's around for U-turns. She did, and here's a big word for you, she did look really discombobulated, i.e. confused every time she stood at the dispatch box.
It's a big word for a man.
I know, yeah, I've been all night thinking about that one. Yeah, it means confusion and indecision.
Yeah.
But I think we've got to park that and key into your topic of long-term investing.
Yeah.
When our investors and clients join, they do an attitude to risk and they articulate their goals of where they're going in the future, where they want to go in the future. And all these risk analysis are based on back testing. These markets have been like this before. There's been many instances through our lives, and even you're younger than we are, where markets have, had a little upset. The COVID pandemic was a recent one. We were telling people to stay in their seats there. Now, of course, there will be short-term pain if you look at it and you get frightened by it. But it is time now to say, okay, I'm on this track to achieve my goals. It's back-tested. It's in secure environment. There's a lot of chat in the stupid chat as well on the media about people's pensions being at risk. Yeah, what's happened in the gilt market has been a shock. And if you're in a DB, a direct defined benefit pension scheme, you may have been listening to it and thinking, oh, my pension scheme's at risk. All our clients are not in those types of pensions. Their pensions are not at risk. And as Mark said, we've made money this week, so your pensions are going up again this week. So it's our responsibility to get through that and tell people, stay in your seats. You've set out on a journey that's well tested, well tried, well funded, very secure, very safe. You need to stick with it. So yeah, that's where I'm coming from.
It's interesting that it's a quote that we've said a couple of times on the podcast that we've heard, which is you can't time the market, it's time in the market. That's the important part of investing. And I think it's when you're looking at your valuations over the last 6 to 9 months, you could feel a bit uncomfortable. I think it's worth if we could put it on the screen, it's worth just looking at the performance of the portfolios over the last 5 to 6 years on the long term basis. And see how that's grown and why you have to look at it from a long term. There'll always be events that go on. As you said, Steve, you probably lived through a few more of these events than I have. But since I joined the organisation in 2007, I've seen a few events in my time of jobs. How do you use it, Mark? Probably one for yourself now. How, as clients, how should we live through these in terms of, you know, you're seeing your valuations, they go up and down as we know. How do you live through this from an investor point of view?
Well, what you said there, Jamie, how do you live through it? Life will go on. Life always goes on, right? And if you've set a long-term goal, and long-term, again, it's a subjective term. How long's long-term for somebody? If you're coming into a pension now, if it's an auto-enrollment pension and you're 25, 30 years old, you're going to have another 30 years before you need to touch on that. That's definitely a long-term goal, and you can take a more aggressive stance with your investment. Shorter term, I think that you do have to keep that goal in mind. And, as you said before, stay in your seat, because we've got figures that show that if you try to time the market and come out and sit in cash and ride out the storms, you'll miss the upturn. And I've said already twice on the podcast so far, this week has been a good week. If anybody sold out last Wednesday or Thursday and are sitting in cash, they've missed around about a 1% return in some of the portfolios. And when you take that and compound it over the years, that 1%, it grows and grows. And we've done 2 weeks seminar tours. We've mentioned this to every audience that we've spoken to. And Jeff did a great job last week in Northern Ireland of illustrating that to the audience that was there.
Yeah, Mark, let's put that on the screen. And Jeff, can you just talk us through that? Because I think that's important.
What we can see just on the screen at the moment is a chart that we've built to illustrate a decision where someone has moved into cash. And what you can see is just the 2 line charts, one person staying fully invested in the balanced portfolio, the other line looking at the decisions to move to cash. Now you'll see 2 flat lines in that chart over that period from 2020. The first of which is during COVID, so a short period of time, maybe 4 weeks or thereabouts within cash. And the second period of time in March 2021, moving into cash for a slightly longer period of time. The key thing to me when I look at this chart, and when we all look at this chart, is just looking at the gap that opens up between the 2 lines. So a very short period of time, so that's 2.5 years, less than 10% of the time in cash, but look at the difference in the return that the individual has earned over that period. That is the key thing about staying invested. Missing out on very small incremental changes to that Mark's point of the power of compounding over just that 2.5 year period makes a big difference. And that's the same if you look at that over the longer term as well.
I think you've got to, and we've said it before many times, you've got to try and take the emotion out of investing. It's just, if you make an emotive decision to try and take your money back from a professional fund manager in these markets, invariably you'll get burned.
It's difficult when there's noise, isn't there, as well, Steve? When there's so much noise over the last 2 weeks, you know, you've been bombarded by news stations, you know, with what's going on. So it's difficult for a client when there's that type of noise. It's how you
think noise is the right way to describe it, because noise can be something that can be interpreted as bad, or noise can be interpreted as something that creates an opportunity. And I think this is where psychology is quite important, that it's the easier decision at times when you're challenged and your views are being really tested is to say, right, I'm just disconnecting from this, I'm going to move away from it, and that may be to move to cash. The other way to maybe interpret some things like that is that it creates a degree of opportunity because prices have changed. So whilst we're talking about volatility and gilts, etc., the return that can be earned, on investments within the portfolios as a result of that has actually increased. So going back to one of those other things that we've often discussed is the role of pound cost averaging and taking advantage of regular investment when the opportunities like this are there. It makes sense for our managers, as they have been doing over recent weeks, to be looking to invest at this point in time, because those returns over the longer term look higher.
Just go in a bit more detail about pound cost averaging, Jeff, because I think that's an important thing for our clients. So if I'm regularly buying, I think just explain a bit more what that means from
the easier way to think about it is that you're just buying at all different prices. You're not making a lump sum investment that locks you in. And I think this is another thing, it's psychological as well. If you invest X at that price, you anchor on that price. Whereas if you're making regular investments, you're not anchoring on a particular price, you're just investing through time. And it's that power of investing through time. You will buy at higher prices, you will buy at lower prices, but that's how you get pound cost averaging through time.
Jamie, it's important to look at this and say that within the portfolios and the funds, we do that because we've got daily cash flow coming into the funds. So the managers that we've got, including True Potential, we can buy assets every day at prices that are there in the market. So taking advantage of volatility is a job of an investment manager, and we do that.
And where have we done that over the last sort of? Is there any good examples of that, Jeff? I think that's a valid point, Mark.
There's a number of examples of it, but maybe the easier ones to focus in are some of the corporate bonds that our managers have been buying, where they've been able to buy bonds that are now yielding 8 and 9%, whereas only 6 to 9 months ago that was 3%. And that is, the real opportunity that's presented at times of stress.
And Steve, just going to you from an advice perspective. So Mark mentioned, we're looking at an auto-enrollment investor where they're, just starting their investing career. We've got many clients who are now approaching retirement or at retirement. What's the importance for those types of clients to stay invested as well?
Yeah, absolutely. You have to, because you're looking at the returns people are getting, and you're looking at the time that people are going to live in retirement now. With a fair wind and a bit of luck, many of us could spend 30 years plus in retirement. So you've got to keep an active investment portfolio into retirement to give you the income that you've set out to get. So it is important that, as again I go back to it, you've articulated your goals. You still have goals in retirement. It may be just that your goal is a provision of a monthly income, but you do need to keep an active portfolio. You can't get wedded to one particular asset class. One asset class being cash, being equity, whatever. You've got to have a multi-asset portfolio that, as Jeff has articulated and Mark, that as one asset class underperforms, the other ones will hopefully come back and outperform. So it's again keeping close to your advisor, or to ourselves if you need to keep closer as a head office, but equally just letting them give you advice and move along and keep you in your seat and doing what you've set out to do.
And the key there, Jamie, is the multi-asset nature of the portfolios, because as the journey changes for each individual investor, you can get the right outcome from a multi-asset portfolio. Somebody who's in the growth stage will have different assets in a portfolio to somebody who's drawing down an income in a pension.
That just bringing to mind things called lifestyle funds. Some companies out there put clients, as you near retirement, they move you into a perceived lower risk environment. Now, that perceived lower risk environment has been quite poorly managed in the sense that it's been generally corporate bonds, gilts and fixed income, which is, in this cycle that we've just had, have been the underperforming asset class. So they've been putting people into a higher risk environment under the guise of putting them into a lower risk environment. So if you are in that type of product, you should be talking to your financial advisor, because I personally, and I don't know about my colleagues here, I never have, but I don't think that's, I think it's an unsafe investment in the sense that you are wedded to specific asset classes. You need to keep the broad nature of multi-asset.
And it's mechanistic as well.
Correct, yeah.
I think it's the mechanistic nature, but also I think we're all mature enough to recognise that nothing is risk-free. So there is always a cost to that. So you have to be aware that there is risk associated with everything. But that's also the opportunity for retirement.
Such as using the word that I used on the podcast. There was risk involved with that, Jamie, that I would pronounce it wrong. But
you didn't.
Discombobulated. Done it again, you see.
It's a good word. I'll Google that later on.
Thank you, yeah. Google's a big word too. So is Bradford, but there you go.
Let's go across to why it's important to speak to your advisor, because I've spoke to many clients over the last few months, actually. Steve, I'll kind of link this into you again, but if you are wanting to, if you're approaching retirement, you thought, well, I was going to retire in September this year, but my portfolio is down, so can I retire? I think it's worth just saying that you should actually speak to your advisor and have those discussions, and there is importance of that. You talked about goal setting and risk profiling, Steve, but kind of just appreciate how important that can be.
Think of the logic of it. Whatever profession that you're in, you become a master of that, hopefully. Now, there's many people out there that are very skilled at what they do. They might be a doctor, a butcher, whatever, but they're not a fund manager and they're not a financial advisor. So you get these people into your life for a specific reason, because they're there with a purpose. Your financial advisor is skilled and trained and qualified and regulated to give you advice on what you should be doing. So you know, you pay a small fee, you should make use of it, and you should talk to your financial advisor. And those financial advisors will put you in touch and put you in portfolios managed by people like Jeff and Mark. It just makes sense, Jimmy. You know, we can't be master of everything, so you should use your advisor. They will be there. They're on, and through our technology, it's really easy, 24/7 if you like, to sort of get in touch and look and make that leap to talking to your advisor. But I would count people to do it. Yeah, absolutely. I do. I'm sure we all do. I'm not a financial advisor myself, and I have one I use. He's in our office. I think he's very good, but if he's not, I'm his boss, so I'll probably sack him. But that's fine. You know, we'll see.
Yeah, no, I think it's really important. We kind of, when we're speaking to clients and you setting that goal and readjusting that goal and understanding that objective is something that, you know, we can really help with. And I think, you know, please be aware that we are here for you, you know, in terms of, even if you just want a brief discussion with your advisor or you kind of just want to know what's going on. I think that's important.
Also the need to have that full consideration of all of your assets and portfolios, how they can work together, and it's certainly the advisor that can do that. So
Mark, we're talking about long-term investing, so from a true potential investment perspective, what's the outlook for us? What are the things that we're doing moving forward that we can tell our clients?
I think, Jimmy, it's not a case of saying, right, we'll stop here and we'll start again. It's a day-to-day thing that we're doing. So every manager that we have, every member of the investment team are looking at opportunities for clients. This month or this week, what we've been doing is we've started the cycle of manager meetings. We're listening to what's been said by our investment partners, and that's led to a meeting yesterday and one further next week where we're looking at the shape of the portfolios again. So if we think there's any changes needed, any adjustments other than what's already happened within the funds, we'll put them into place next week. I think that also the longer term nature of things, there are some short term tactical moves that people can make. You know, we are in a time of uncertainty. We don't know who's going to be the Prime Minister, who's going to be the next Chancellor, who will form a future government. But what you can always do is take control over the things that you can influence. And speaking about, you know, Steve said about the advice side there, if you haven't put money into your ISA, you know for sure that there's an ISA allowance which will be available this year. Put money into the ISA. Same thing with your pension. Top your pension up now when there's the opportunity still to do it, because we don't know what future governments are going to do. So use those opportunities. Get money into the portfolios, get money into your pension, get your tax, relief that's coming into the pension as well, and maximise those allowances.
That's a cracking point, and we should mention it every time we speak. If you invest in a pension, you will either get 20%, 40% or 45% straight on. Now, where are you going to get that growth?
That's right.
It's an absolute no-brainer that you should use it.
It is interesting because I'm personally guilty of this sometimes. I think probably go away and do this afterwards, Mark, but I'm guilty of this sometimes where I potentially wait till the end of the tax year and go, right, I'll put a little bit more in my ISA or a little bit more in my pension. And it's a great opportunity at this minute in time to, if you are going to be doing that, so if you're a business owner or anything like that perspective and your accountant tells you to put an employer contribution in, it may be a good time to do it based on current prices.
Absolutely.
It's also back to that point of pound cost averaging. Through time, you're just taking the benefit of that. I
think it's pound cost averaging and setting a goal, your objectives and where that lies, and don't deviate from it because of the short-term volatility that's going on in the market. We do believe things, they must get better, Steve.
Well, that's the point we need to make. If you look at where we are, and stability has to come back from here, we're going to get a Prime Minister, I suspect, next Monday that will last 2 years, and then maybe a Chancellor, it might be the same one, will last 2 years. So we'll get 2 years of stability. If you look at a lot of the projections on inflation, it is, let's take Ukraine as a kind of whatever it is, hopefully that will play out and finish at some point. But inflation is predicted to come down. So we're looking at, probably last week was the bottom of the abyss, if you like, and we're going to get stability. We're going to get markets returning to some kind of normality. And as Jeff has said, there's some cracking opportunities in these markets for people like Jeff and his team and the fund managers to take. So, I think we're past the worst, everybody. Famous words. My own feeling is it can't get any worse than it did last week, the stupidity. But we're getting on now, and we'll get stability and move forward. And that's what the market's
probably
like.
What we've seen this week, to be honest. You've certainly seen how the sovereign bond market in the UK, the gilt market, has reacted.
from a client perspective, when you're looking on your client side, it does feel a bit calmer. You know, what's happened over the last few weeks, because it did feel like a shambles and chaos at one point a couple of weeks ago from a government perspective.
It was, but it was how that fed into the market was that you were seeing 3 and 4 standard deviation moves in sovereign bonds, not just on a weekly basis but on a daily basis, and that's something that is very disconcerting for us all when you're looking at a screen that's suggesting a sovereign bond's just moved 20%. It's quite a significant move to take into account. But then again, it's there. It's the reality of what we have to deal with. We have to, as Mark was saying, navigate our client portfolios through all of these events that are there, and that's what multi-asset allows one to do.
And we've dealt with it many times.
Yeah.
And we'll deal with this situation like we have in the past.
I mean, we won't. You think of what happened 2 weeks ago today at the mini budget. That won't happen again. That was absolutely radical that happened there, and it caused an absolute firestorm. You know, budget responsibility muted, Treasury Mandarin sacked. You know, ridiculous, really. I don't know on what planet they were thinking that could just move sweetly into the markets and provide what they wanted. And it won't happen again. No. So, if that was the bottom, that was the bottom.
Yeah, great. Well, I think we'll leave it there, gents. I think we've discussed a lot on that. I think, you know, the key messages from today's session is stay invested, long-term investing. Look at your goal, and ensure that we're here for you when we need to speak to you.
I think, Jamie, just to close it off, we talked about noise earlier on. Our job is to just manage the money, listen to the relevant factors that are being discussed, look at what's being said, not only by government but by central banks around the world, and position portfolios to navigate through this.
Yeah, agree.
It's like your football team, Jamie. Stability. You choose it. It chooses you at birth, and you stick with it, don't you, Mark?
Well,
you do, Steve.
We look pretty stable at the minute, Mark.
Well, I'm going to Grimsby tomorrow, so we're pretty stable too. Watch for that. Grimsby at home against Bradford tomorrow, everybody. An away win on your coupon.
I'll back that on my pools. Great, thank you very much, everyone. A really good session, and thank you for listening. As I said, if you do have any sort of queries or questions, we're here for you. Thank you. Hope everyone has a great weekend. Thanks, gents.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.